Hi everyone, welcome to CP Commerce for YouTube channel. This is useful for all MCOM and MBA students. Today we are discussing about the risk returns and trade-off. There is a direct relationship between the risk and the returns. Present days, the business does not take any risk. The business will not get any more returns. So business wants to return, it has undertake the risk. So before taking any risk financial decisions, the financial manager was must considered how much risk is involved in this decision, properly controlled. Higher the risk, higher the returns. If you get lower the risk, lower the returns also. Financial manager should concentrate on returns along with the responsibilities to calculate the risk involved in this. It means how actual it means how the actual returns are deviated from the expected returns. How much actual sales are deviated from expected sales, right? If we are deviated more is called as a risk. Is easy understanding. I will take one example. You are expecting 1 lakh rupees, but actual returns get only 40,000 rupees. Here lot of difference, right? Difference between expected and the actual, it is called as a risk. It impact on working capital regarding the investment decisions. Risk is found of different types, like financial decisions, business decisions, economic decisions, political decisions. Every financial decision has some risk trade off. So, profitable financial investments plans can develop a appropriate evaluation and balancing the difference risk returns and trade off. So, every financial decision, whether it is investment decision or financial decision or dividend decisions, and also financial working capital decisions, every decisions involved in the returns as well as risk. So both should be considered evaluating the financial decisions. Four broad decisions of financial decisions. One is capital budgeting decisions. It is also known as investments appraisal decisions. For easy understanding, decision is taking in getting the returns and also getting returns. Risk is attached with the returns. We cannot separate that returns and the risk. For easy understanding, I will take one example. Purchasing of machine or building, it gives the long term assets, right? In case of business get any losses, we can't use it properly, right? Coming to capital structure decisions, it means there is a financial decisions from the business must procure the funds, raise the funds. It should be funds should be raised. If you want easy understanding, if you want 50,000 rupees, shareholders gives 20,000 rupees, debentures gives 10,000 rupees, equity shareholders gives 20,000 rupees. Like that we have to get the amount, right? This is separation of capital structure is called as a structure of capital. It is also involved in risk as well as the returns. Coming to dividend decisions, right? Dividend decisions concerned with how much amount it should be distributed in the form of dividend, how much retained it gives. Every shareholders must expect some dividend, right? The dividend is distributed in the profits only. Profits is distributed as a dividend to the shareholders, and some amount it should be kept as a retained amount. Retained amount it should be used as a uncertain conditions. Coming to working capital decisions, here how much amount it should be invested in current assets and how much amount it should be able to pay that current amount liability to take time. So that business must have good liquidity position. So every decision regarding the working capital will also have an impact on returns as well as the risk, right? When returns and risk is undertaking directly, it have impact on objectives of financial management is also. Objectives of financial management is maximizing the profits and wealth maximization of shareholders, right? When market price of the shareholders increase, then market share value is also increased, right? When market price is also increased, the market value of share will be increased. So all the financial decisions will have the impact of market price of share value. Here risk is equals to the trade off. Thank you.